This is Nightly Business Report with Bill Griffith and Sue Herrera.
When companies get where they're sort of living by so-called making the numbers, they do a lot of things that really are counter to the long-term interests of the business.
Warren Buffett and Jamie Dimon join forces to change Wall Street's short-term focus. But is ending quarterly guidance in the best interest of investors?
Apartment glut. There may not be enough homes for sale, but there appears to be an oversupply of new rental units.
Taking off why this summer's must-have ticket is a flight to Europe. Those stories and more tonight on Nightly Business Report for Thursday, June 7th.
And we do bid you good evening, everybody. We begin tonight with developments on geopolitics and trade, issues that certainly have moved the markets over the past few weeks. First, Secretary of State Mike Pompeo said today that North Korea has confirmed its willingness to dismantle its nuclear arsenal. That revelation comes just days, of course, before the scheduled summit between President Trump and Kim Jong-un. But before the president heads to Singapore for that, he will be meeting with G7 allies in Canada, where contentious discussions over trade and tariffs are expected. It certainly will be a big event for investors and the market, which today finished mixed as bond yields dipped. The Dow Jones Industrial Average was the lone gainer of the major averages, advancing 95 points to 25,241. The Nasdaq cooled after a series of record closes, down 54 points today, with the S&P off about 2.
The U.S. has struck a deal with the Chinese telecom company ZTE, which has become a linchpin in trade relations between the U.S. and China. Now, some say the agreement may point to progress in the high-stakes trade talks. Commerce Secretary Wilbur Ross says ZTE will pay a $1 billion fine in return for ending sanctions on the firm.
It imposes the most strict compliance that we've ever had on any company, American or foreign. We are literally embedding a compliance department of our choosing into the company to monitor it going forward.
In April, the U.S. banned exports to ZTE as punishment for making sales to North Korea and Iran.
Warren Buffett and Jamie Dimon are setting out to dismantle one of the bedrocks of Wall Street tradition. The two powerful business leaders are urging companies to stop issuing short-term guidance and instead focus their thinking on the long term. Becky Quick spoke with both of them exclusively and started by asking Mr. Dimon why he thinks this issue is so important.
We all feel a tremendous obligation to deliver in the long run, to build great companies, and that therefore corporate governance is important. And one important step, and I actually really learned this by listening to Warren, is some of the ills and problems of people making short-term forecasts, particularly quarterly earnings forecasts. Earnings forecasts, not transparency, not openness, not having quarterly reporting, and it can often put a company in a position where management, from the CEO down, feels obligated to deliver earnings and therefore may do things that they wouldn't otherwise have done. So if you have a good board, the board will say, if you have a great investment opportunity, and you say it's going to cost me another couple $100 million this quarter, someone like Warren would say, absolutely do it. That's good. That's future earnings. Don't hurt your company because you're trying to meet a short-term thing.
Warren, this is something you've been preaching about for a long time, too. What's an example of where you've seen it gone wrong?
Well, I've seen when companies get where they're sort of living by so-called making the numbers, they do a lot of things that really are counter to the long-term interests of the business. And I've never seen a company whose performance has been improved by having some forecast out there by the CEO that we're going to earn X, because it's not only sending the wrong message and delivering the wrong results to the company and to the country, it's also teaching the people that work under him or her that quarterly performance is the end game. I tell our managers, just pretend you're going to own, this is the only business you and your family are going to own for 50 years and you can't sell it, and you'll make the right decisions.
Have you seen this kind of play out the wrong way, either in the boards that you've sat in or the companies that you've owned, other friends that you've known?
Becky, I've been on 20 boards of publicly owned companies, not counting Berkshire's, and I have seen I have seen managements that I really think well of personally. I'd be glad if they married my daughter or were named as executors of my will or moved in next door. But they get tempted by the predictions that have been made. Their ego gets involved, and when they find they can't make the numbers, sometimes they make up the numbers. And it's a very, very bad practice. And once it gets going, it feeds on itself, because if your investor relations department tells you, you know, that we put out you're going to earn $1.08, and you get this reputation for, you know, making your numbers or beating your numbers, you're going to do some very stupid things at some point, because business just doesn't work that way.
Now, this isn't the first time that Buffett and Dimon have criticized earnings guidance. They signed a letter back in 2016 which addressed the issue and advocated for better corporate governance standards.
And it is not just Warren Buffett and Jamie Dimon who are proponents of eliminating short-term guidance. Tesla's CEO, Elon Musk, had some thoughts on it as well recently.
The problem is, like, people get too focused on, like, what's happening in the space of a few weeks or a few months. This is, you know, it's an old maxim of investing. You should not be focused on short-term things.
And back in 2016, BlackRock CEO Larry Fink sent a letter to 500 CEOs urging them to stop providing quarterly earnings forecasts. So should companies provide investors with short-term guidance? We are joined tonight by William Lee, chief economist at the Milken Institute, who says no, not always, and Vahan Janjigian, who says yes, companies should. Gentlemen, nice to have you here. A pleasure.
Thank you. Nice to be here.
Vahan, I'm going to start with you because I think Mr. Buffett and Mr. Dimon laid out the reasons why perhaps you should not provide, as a CEO, short-term guidance. Briefly tell me why you think most companies should.
Well, there are a number of reasons. You know, first of all, let me point out that most CEOs would prefer to put out as little information as possible. They would prefer to put out only what's required and nothing more. But the reason they give earnings guidance, which is not required, is because the investors demand the information. And investors are telling corporations that if you don't give me earnings guidance, if you don't disclose the information, I may not pay as much for your stock. And that's the same thing as saying that the company's cost of capital goes higher. Now, this isn't a key issue for a company like Berkshire Hathaway, who has a star like Warren Buffett running the company. I mean, a Berkshire Hathaway shareholder doesn't really care about guidance because they really trust the CEO. This is a more important issue for smaller companies. Furthermore, guidance comes directly from the horse's mouth. It comes from the management of the company. If management stops giving guidance, Wall Street analysts are still going to come out with their estimates, but what's guaranteed is that those estimates are going to be less accurate because they don't have management guiding them. And furthermore, the other issue is transparency and disclosure. This is information, and we're in an era where the SEC wants more transparency and disclosure, so why hide the information?
William Lee, so you agree with Buffett and Dimon. Make the case against short-term guidance.
The only people who are really interested in the earnings number are the investment analysts out there making their own forecasts, and companies need to anchor those forecasts before they become too wild. As an investor, what we're interested in is the strategy behind the numbers. What is it that the management is doing, planning to do, and how did it do it? What are the risks to the strategy? That narrative is the critical part that every investor has to be interested in. The number is just a number, and what we need to know are the rationale behind the numbers. As long-term investors, you say, well, it's a sequence of short-term events that make up the long-term. Absolutely right. And we do need information, but information that's relevant for the operation of a firm, and let the managers do their job. Don't micromanage their numbers. One of the things that we talk about disclosure, we need informed disclosure, and that comes with a narrative, not a number.
You know, we did a study of the S&P 500 companies. Of those, 170 don't provide short-term guidance. But we looked at the 5-year performance, comparing those companies that do provide short-term versus those that don't provide short-term. And if you're thinking about the impact this has on individual investors, it's almost a wash. So is there an argument then to keep the short-term guidance?
Yeah, there's a difference between companies that don't provide guidance and companies that previously provided guidance and then stopped. I mean, Berkshire Hathaway, for example, has never provided guidance. But there are academic studies that show that companies that provided guidance, when they stop providing guidance, you have a negative stock price reaction. Furthermore, fewer analysts now cover the stock, and the accuracy of the estimates deteriorates.
But
another argument that's often made, by the way, is that we want these long-term valuations, so stop giving us guidance and give us more information about what the company is worth over the long term. These studies show that that does not happen, and furthermore, there's no evidence that these companies invest more money in things like research and development that would increase the value over the long term.
William, did you want to say something in response to that?
The key is, do we induce mark-to-market volatility into stock prices unnecessarily? And hitting a number, or focusing on a number, does exactly that. Informed guidance, absolutely, no question about it. We need information about what the company's doing, but we don't need a number. We need a range of numbers, and we need management to tell us why they're going to be at the upside or the downside, or why the environment would force them to change their strategy. That's the kind of information that's relevant for markets and relevant for investors to assess whether they want to be in that company or go into another company.
Well, there are very few companies that give us a number. I mean, most companies do give us a range to begin with.
It's the narrative. I don't care about the numbers. I want the narrative and story behind the numbers. And that's something that the short-term investor community doesn't focus on.
But you also mentioned volatility, and that's what people are really most upset about. Investors get very upset when a company earns or misses the earnings estimate by a few pennies and the stock falls 10%. That's what gets them upset. But eliminating guidance is not going to get rid of that problem.
Let me give you a metaphor. The Fed. If the Fed didn't put the number of dots up there, we would have much less debate and would focus on the long-term strategy of how the Fed's going to get rid of inflation. And that's what's relevant for keeping markets calm and for guiding the economy. Same thing applies to companies.
Before we let you go, William Lee, I had an example. I looked at Kroger. You know, they recently announced that their profit margins were going to be squeezed a bit because they were making more investments in their e-commerce business. And immediately, you know, alluding to what Vahan was saying, that stock dropped by 11%. You know, you have to think that that's going to play with the CEO's mind. They might think twice about making long-term investments if they know that the stock is going to suffer in the short term.
Absolutely. The forward guidance incentivizes them to make short-term conservative bets and not the long-term gains. Look at Amazon. They had miserable earnings numbers for the longest time, and yet everyone believes Amazon is a success story.
All right, you guys need your own cable show.
Good stuff.
Or just come back on ours, okay? Thanks so much. William Lee with the Milken Institute and Vahan Janjigian with Greenwich Wealth Management. Bill?
Elsewhere, household wealth in the U.S. has now topped $100 trillion for the first time. According to a new report from the Federal Reserve, rising home prices lifted wealth in the first quarter, and that offset the impact of a decline in the stock market. Meanwhile, household debt remains stable, staying in a range that it has been in for the last few years.
The number of Americans filing for new unemployment benefits fell last week. The report signals continued strength in the labor market. Initial jobless claims, also considered a proxy for layoffs, fell by 1,000 to a seasonally adjusted 222,000. As we reported, the unemployment rate currently stands at 3.8%, the lowest since April of 2000.
And as the unemployment rate continues to decline, more and more companies struggle to find workers. Last night, we took you to Louisville, Kentucky to introduce you to a unique program that is attempting to solve that problem. Well, we take you back there this evening to see how some big companies are getting involved. Steve Leisman once again has our story.
It may seem strange and a little out of the box, but a cardboard boat race in Louisville, Kentucky is seen as part of the solution to a national worker shortage problem. It all looks like fun and games, but behind it are some serious high school students studying computer-assisted design, or CAD.
I never knew I was in engineering. I was good at math. I liked drawing and all of that, but once I got to the CAD, I was like, wow, I really like this. I could do this. I'm really good at it.
The Cardboard Boat Regatta is the capstone event for students who have spent the year studying sophisticated AutoCAD and CNC machines to prepare for careers in commercial design and engineering. Their task? Float a boat using nothing but cardboard and duct tape. Kylie and her classmates are just a handful of the more than 17,000 students pursuing career-specific education through the innovative Academies of Louisville program, the city's answer to the economic challenges it faces with a low 3.4% unemployment rate. It's not far off the national rate at 3.8%, near a two-decade low.
Business was used to having labor show up at the door ready to go. And there was more availability of labor, but then also business wasn't as complicated.
So far, 85 businesses, including UPS, General Electric, and Norton Healthcare, have partnered with the public school system.
Is one of the best kept secrets that we have here in for Louisville is that we have an aviation program. An aviation program that's very rare. I think it's probably, if not the only one, but the very few that's in the country, where a young person can come as a middle school student, go all the way through high school and obtain their license.
We provide that specialized training, but also those other skills that we want kids to have. The communication skills, the collaboration skills, the persistence.
Skills you might learn in a cardboard boat race, where some of the boats sink and others go on to win. But the kids learn a little something along the way about computer design, the limitations and possibilities of duct tape, the job market, and life. For Nightly Business Reports in Louisville, Kentucky, I'm Steve Leisman.
And still ahead, we hear a lot about the shortage of homes on the market, but could there be actually a glut of apartments?
Mortgage rates moved lower again this week for the second week in a row. This is only the second time this year that rates have fallen in back-to-back weeks. Freddie Mac reports that the 30-year fixed rate average slipped to about 4.54%. But economists say the pullback may be short-lived since interest rates are expected to resume their march higher.
We have been telling you lately about the shortage of skilled workers in the labor market. The construction industry in particular is feeling the effects of that. But it's having a strange impact on the nation's apartment market. It's causing an oversupply. How is that possible? Diana Olick explains.
Across America, single-family homes and apartment buildings are going up, but the process is slow and expensive because of a severe shortage of skilled construction labor. Developers, small and large, are feeling the pain, even Warren Buffett.
We have 6 or so home building operations in various places, Kansas City and Denver and Austin, Texas, and there is a shortage of the labor required in home building throughout the country.
In the apartment market, the shortage is actually causing an oversupply of new buildings. That may sound backwards, but here's why. First, the construction industry lost over 1 million skilled workers during the housing crash, and most never returned. Then, after the crash, when home ownership was at a record low, developers tried to meet the high demand for rental apartments, but it took them a really long time to build what they started because they didn't have enough labor. So a lot of the new buildings that were supposed to be finished when demand was high were not.
So what happened in supply that was supposed to come out in 16 pushed into 17. What came on in 17 got pushed into 18. What's supposed to come this year is probably going to push to 19. So for apartment investors, it's been a real challenge because every year we think, aha, this is the peak supply and it's going to decrease from now. But unfortunately, what's been happening is it gets bumped into the following year.
The number of apartments completed in the U.S. hit a 30-year high last year, according to RealPage, but occupancy was still good at 95%.
The concern now is going forward. More apartments coming to the market with less demand will mean concessions and lower rents. Great for renters, but not for developers who are already paying top dollar for lean labor to top off their projects. For Nightly Business Report, I'm Diana Olick in Washington.
McDonald's is cutting jobs, and that's where we begin tonight's market focus. The fast food chain said it would lay off an undisclosed number of workers in an attempt to streamline operations and reduce its costs by the end of 2019. McDonald's said it would offer more guidance on the number of positions impacted during its town hall meeting, which is set for June 12th. McDonald's shares rose 4% to $169.48. J.M. Smucker said weaker demand for its peanut butter and its baking products caused profits and sales to disappoint. The maker of Jiffy and Pillsbury also said an increase in marketing and freight costs would cause its earnings for the year to come in weaker than expected. Shares were off 5% to $100.80. And Ralph Lauren is launching a $1 billion share buyback and hiking its dividend 25%. The retailer also expects sales to rise at a compound annual rate in the low to mid single digits. Operating margins are seen growing in the mid-teens. Shares, nonetheless, were 1% to the downside to $137.86.
Furniture retailer Conn's turned a profit and saw revenue rise above estimates. Company cited an increase in same-store sales and improved margins. Conn's also sees same-store sales for the current quarter coming in better than expected as well. Shares popped more than 24% today to $31.95. Vail Resorts sold more season passes, and that helped overall earnings rise and top expectations. The ski resort operator said that the strong quarter gives it confidence that it can expand into more U.S. markets, and shares climbed more than 4% today to $270.72. RV maker Thor Industries reported weaker than expected earnings and said that it is concerned about the steel and aluminum tariffs that were recently implemented by the U.S. The government. Thor said that it is already seeing an increase in raw material costs and is taking actions to try and offset those increases. Shares initially fell on that news, but then recovered, rising by 2% to $100.80.
Coming up, globetrotting, why airlines are ramping up service in the busy transatlantic market.
Airlines have recently started warning passengers that fares may soon be going up, and you can blame increasing jet fuel prices, which have risen more than 50% over the past year. Fuel is the single largest expense for most airlines, accounting for about a quarter of operating costs. The potential rise in airfares comes after 4 years, though, of declining prices.
What is the hottest ticket for a summer vacation this year? Well, it might be going to Europe. In fact, the number of transatlantic flights has skyrocketed as low-cost and legacy carriers add new routes to new markets. Phil LeBeau has more.
When Iceland Air made its initial flight to Dallas last month, water cannons not only signaled the beginning of service to Reykjavik, they also marked the start of a boom in flights from Texas to Iceland. Recently, low-cost carrier WOW, which is also based in Iceland, started flying to Dallas. Not to be outdone in its home market, American Airlines has added daily flights from Dallas to Reykjavik. Is there really that much demand to visit Iceland? The fact is, airlines big and small are expanding service across the Atlantic, not only to Reykjavik, but all of Europe. In the summer of 2014, there were 168,000 transatlantic flights. It's been steadily increasing, and this year there will be more than 215,000. Most flown by legacy airlines like Delta or Lufthansa. But increasingly, low-cost carriers like WOW are adding cheap flights from Europe to the U.S., some as low as $99.
We don't know if all of these airlines have financial staying power, so this may be a great summer.
The strong economy means there's plenty of people ready to take a trip to Europe. But with jet fuel prices skyrocketing, it's costing airlines more to fly across the Atlantic. And industry veterans wonder if higher costs will force airlines to cut back.
If indeed, I think it becomes clear this is the new normal, I think you would see over time less capacity growth in the industry, therefore higher prices. But there's nothing, I don't think it's going to happen in the very near term.
So far, legacy airlines have shown they will not give up market share flying to Europe. And for good reason. The legacy airlines have all expanded their service to customers willing to pay more for things like business class. So flying to Europe is still a very lucrative business. Phil LeBeau, Nightly Business Report, Chicago.
And before we go, another look at the day on Wall Street. A mixed day. The Dow advanced by 95 points, still above 25,000. The Nasdaq cooled off, down 54, with the S&P down about 2 points today.
And that will do it for us tonight on Nightly Business Report. I'm Sue Herrera. Thanks for watching. We want to remind you this is the time of year your public station seeks your support.
I'm Bill Griffith, and we do thank you for that great support. Have a wonderful evening. We'll see you tomorrow.